In this presentation, we will look at the customer section of the home page demonstrating the receivable cycle or sales cycle. For more accounting information and accounting courses, visit our website at accountinginstruction.info. Here we are on the home page, which can be found on the company dropdown and home page. We also have the Open Windows Open, which can be found in the View tab and Open Windows list. If you want to jump straight to entering data into the system, you can go to the lectures that start with a 6 within the video. We here, however, are going to start by navigating through the system, getting an idea of how the system works. We're concentrating on the customers section, and QuickBooks gives us a nice flowchart of the flow of documentation. And as we look through the flow of documentation, we can see what the journal entries will be and how QuickBooks will construct the financial statements. Really good idea to look at these and look at the flowchart so we know the process, the general process that most companies will go through and fit into with regard to their sales cycle. So we're going to go through these flows, and then we want to think of the journal entry, what the effect is on the financial statement for these items. Remember that in financial accounting, we often think of transactions in terms of the accounting equation and or in terms of debits and credits. These here are going to be driving the transactions that will be in accordance with the accounting equation and debits and credits, but we want to keep the data input as easy as possible so that we can enter these forms without necessarily knowing that information. In order to set up the forms, we do need to know that information, so it's a good idea to think about those things as we think about what these documents are actually doing. So we start off here in the customer section with the estimate. So if we make an estimate, not all companies will have an estimate, but if you think of something like a construction company may have an estimate for a job that they would first put together. That would be the first item that we have. Not really a journal entry related to the estimate because no job has happened and no money has been received at that point in time. So no transaction at this point. Not all companies will have estimates. Most companies will have invoices, and the invoice is going to be similar to the create the sales receipt. These are going to be similar types of documentations that will have similar transactions related to them. The difference between these two and which one will be used most by a company depends on what type of company we are. For example, if we're a service company, for example, a bookkeeping company, a law firm, a CPA firm, we're probably going to be using the invoices more. And the reason is because we're going to do the work before we send the bill to the client. This is going to be a bill to the client in essence. We're going to have to do the work. We're going to have to make a bill for the work that was done, send it to the client, and we're going to get paid at a later time. As opposed to the create sales receipt, which might be something like a restaurant or any kind of business where we get paid at the same point in time. If we get paid at the same point in time, then we're going to use the create sales receipt, and that'll record the transaction of both the transaction happening, the receipt of the payment, and the recording of revenue at that point in time. So the look of these documents will be much the same, and they'll really just differ in terms of what type of industry we are in. If we're in an industry where we have to bill the customer and then they're going to pay us in the future, we really need to track who owes us money. And that's account is used is accounts receivable. So this invoice is going to be hitting accounts receivable or increasing accounts receivable when we enter the data into it. So let's see what an invoice looks like. If we go through the invoice, looks like this. If I pick a prior invoice, I'm just going to go back here, use the previous icon. This is going to be a typical kind of invoice we have. Now, an invoice is going to be more or less complex depending on whether or not we sell inventory. If we sell inventory, the invoice is actually doing a lot more than it would if we're just a service company in terms of the accounts that will be affected within it. So be aware that when you're dealing with some companies, or if you're thinking about what type of bookkeeping you want to do for a bookkeeping firm, what type of clients we want to have, then be aware that the inventory, if we are tracking that inventory within the system, adds a good level of complexity. If we're talking about a service company or not tracking the inventory within the system, then it's going to be easier for us to enter the data and set up the data. So here we have the customer up top. We're going to have the template, we're going to have the date, and then we're going to have the item down here. In this case, this is an inventory item that we are selling. So we're selling an inventory item, in our case, guitars. We're going to sell guitars. This is an Epiphone Les Paul guitar. The data input for this is going to be very easy. we're just going to enter this data, and then we're going to give this invoice. We're going to ship it out, or we're going to mail it out, or we can email it to the customer after the work was done, and we expect to receive payment in the mail. So the basis of this invoice then, and any invoice, is going to be the invoice means that accounts receivable is going to go up. That's what an invoice means. So in terms of the actual formatting and what's going to happen to the financial statements, in the accounts receivable, people owing us money will go up. And the other side of the invoice is going to be some type of revenue account, because we recognize revenue when the work is done. So that's going to be the main thing, whether it be dealing with inventory or not, whether it be a service company or a company that sells stuff, sells inventory. So let's first consider what that's going to do to the financial statements. So we'll open our favorite two financial statements, the balance sheet and the profit and loss or income statement. Going to go to the reports up top. We're going to go down to company and financials, and we're going to go down to the balance sheet standard, Select that item. We're going to change the date range up top by going to the customize reports up top. And then we're going to have the range here, which is going to be from 01/01/19, January 1st, 2019, to 12/31/19, December 31st, 2019. And that's the easiest way to type it in there. I hit tab to go through there. You can type it in with the full date or use these little drop downs. That will work as well. And then we're going to say OK, and that'll give us our report. The main thing we want to note is when we first enter that data on the balance sheet, it's going to open up, it's going to increase this accounts receivable account. This is the account showing that people owe us money. If we double click on that, we'll see that what's creating these are invoices. So all these invoices are increasing the accounts receivable. So I won't pick the actual invoice we were on, but if we just pick any kind of invoice here, and we just double click on any one of these invoices, anything with an invoice on it, we'll see that it will go to an invoice. So here's going to be an invoice increasing the accounts receivable. Closing this back out with this little X up top. Closing this back out. So that's going to increase the account that shows us that people owe us money. We expect to see money in the mail. Now there's going to be some supporting documentation too that will track that by customer, because we want to know who owes us this money as well. But that's going to be the basic idea. We need to have this accounts receivable to know who's going to owe us money and track that. So the other side is going to go to we're going to go to reports up top. We're going to go to company and financial, and we're going to go to the profit and loss, the other main report we're going to go into all the time, profit and loss. We're going to change the dates once again to 01/01/19 to 12/31/19. That's January 1st, 2019 to December 31st, 2019. Refresh, or just click down here and it'll open up. The other side, in our case, is going to go to merchandising sales. So merchandising sales, if we double click that item and scroll down, we'll see this is the other side also being made by the invoices. So if we select the invoice, double click on an invoice, let's select this invoice, then it'll give us the invoice. So the invoices are making the sales, or increasing the sales. This is revenue or income sales. Closing this back out, closing this back out. So if we go back to the home, that's the one thing that's going to happen all the time when we enter the invoice, whether it be a service company or a company that sells inventory. So if we go back into this invoice again, I'm going to go back to the invoice we were on. Now also note that this will do something else as well if we have merchandise. The merchandising invoice drives a lot more than that, because it also has to record the sales tax down here, which will be recorded in sales tax payable. So we won't discuss that now, but just be aware that if you're dealing with inventory, it's a little bit more tricky. And then it's also recording the decrease in inventory, because we sold the inventory here, meaning the inventory has left the company. So we have to decrease the asset of inventory, which you can't even see the number here for it, although the system knows what it is. Again, we won't go into how it knows or how these numbers are generated now. We will when we generate the invoice. And the other side is going to be the cost of goods sold. So in other words, it will track perpetually in a perpetual system. It'll track inventory using the invoice. The invoice will drive that. We'll talk more about how it does that later, but just be aware that the other side of this, if you have to deal with inventory, has to deal with the decrease of inventory, and the recording of cost of goods sold, that is driven by the invoice. So if we close this back out, using this little X up top, The next thing that's going to happen, of course, is we receive payment. So in our little flow chart, the next thing is we expect to receive payment. We can imagine that we shipped a guitar in our case, and we're going to receive payment in the mail. So we get within the mail, we get a payment. And if we select the receive payment, it looks something like this. And this screen is very standardized. You can see that it doesn't have any accounts. What it will have is a list of invoices that are still outstanding here that have not yet been paid, if there were any invoices that had not yet been paid. And if we select any of those, say we got a check and we selected an invoice for $500 and we got a check for $500, this then would create a journal entry without even seeing any accounts here. This customer payment means that accounts receivable is going to go down because we got paid by the customer. So it means accounts receivable is going to go down. And if we got paid by a check or cash or whatever we got paid with, we would think that the checking account would go up. But the tricky thing is here, it's not going to go into the checking account. It's going to go into an account called undeposited funds. And we'll talk more about that as we go through and why we would use an undeposited funds. It is possible to put it to the checking account and override that. But we'll talk about why we would want it there, and the main reason is so that we group the deposits in the same way that they will show up on the bank statement. So if we go back to our balance sheet then, in our open windows, we're going to go to the balance sheet. And we say, okay, in that case, when that happens, what's going to happen is accounts receivable is going to go down. So if we double click on accounts receivable, I'm up in the assets and accounts receivable, double clicking and zooming in on it, and we scroll down, we're going to say, here's a payment. That's what's going to happen when we hit that payment. It's going to make a payment item, payment type thing here. So if we select any of these payments, then it's going to show one of these payments. So this payment means that it's going to decrease the accounts receivable. The accounts receivable, I just closed that out with the X. The accounts receivable is going to go down by the payment we receive, and it's going to be driven by that little form. Now I'm going to close this out with the X up top. We're going to close this out. That should bring us back to the balance sheet. Now the other side, there's always two sides that are going to happen anytime we make something, is going to go into this undeposited funds, which should look funny if you're looking at financial accounting. You've probably never heard of undeposited funds, and you would think it would go into cash or the checking account. But here's the undeposited funds. If we double click on that undeposited funds account, then we'll see then the payments then are here, and when we have the payment, it's going to be increasing the undeposited funds. So if we select any of these payments, we'll see that it will be increasing the undeposited fund. So here is another example of our payment that we had. So then we're going to close this back out. Close this back out. This is a troublesome account for many people because it can get messed up. We can say, well, why is it in undeposited funds, and get that step mixed up. And we'll see that as we go through the problem, what the undeposited fund is used for. It will then go from there to the checking account, as we'll see in the next step. So we're going to go back to the home page in the open windows. The next step in our flow chart is to make the deposit. So if we just went straight through, we'd have the invoice. Now we collected payment on the invoice, and then of course we're going to go to the bank and make the deposit. These two things are going to be different because this means that we, in essence, have the cash in hand or the checks in hand or whatever form of payment. When we go to the bank and make the deposit, then this is going to tell QuickBooks now it's in the checking account. And the reason we need that separate step is so that when we go to the checking account, we group the deposits in the same format that we deposit them into the bank. So if we get multiple checks throughout the day within our business, we go to the deposit to the bank at the end of the day. We're going to put all those checks into the bank with the same deposit. And therefore the bank is going to record, even if there's multiple checks, they're going to record it as one deposit, and it's going to show up as one deposit on the bank statement. And a huge internal control that we have is matching our bank statement to our books. And that's way easier to do if the deposits on the bank statement are formatted in the same way that we have them in our system. So that's the point. That's the point of the undeposited funds. We're trying to say, hey, these are undeposited, and we want to group them in the same format as we enter them into the banking system. We also want to track what's on hand, what's in the store, with what is in the bank, so that we make sure that we go to the bank periodically and make those deposits. This little red item up here will show us how many deposits have not yet been made, meaning this red item means we have an outstanding received payment and or credit sales item that is not yet gone to the bank according to the system. If we select the record deposit, then it'll give us this little pop-up saying, hey, this is an item that you haven't gone to the bank with. If we had gone to the bank, we don't have any of those, then we'll just have this normal deposit screen. If this is an item we're going to the bank with, we would check it off and go to the bank with it. I'm just going to close it for now. And let's go back to a prior deposit just to see what it looks like. Here's a prior deposit. And the deposit will then finally increase the checking account, and it will increase that holding account, that undeposited funds account. That's what the deposit is going to do. So let's just take a look at that. If we go to the balance sheet, we're going to say if we go up to the checking account, here's the checking account, double click the checking account. And if we see any of these deposits here, if we go to any of these deposits within the type, that's going to be driven by that screen that we just looked at, a deposit type screen. If we double click on them, let's go to one down here. We have a deposit. Let's go to this deposit. Any of them will work, but let's go to a deposit and just double click on a deposit. And you'll see it will go to a deposit screen here. This is the screen that will drive the deposit. Even if we put a deposit directly in the check register, QuickBooks will still generate a form like this. So we can put the deposit directly in the check register, and we'll see examples of that when we create some problems. But the QuickBooks will still drive the form. This is the form that QuickBooks sees as a deposit. So we're going to close this back out. We're going to close this back out. The other side is typically going to be undeposited funds. So we're going to go to undeposited funds here and double click undeposited funds. And we'll see the data. Now note if the data doesn't pull up, that's because you need the range. So if we didn't hit the range up top, you need to change the date range. So if we're going to go down to one of these type of deposits, any of the deposits items will be decreasing undeposited funds because they are now deposited, meaning they're no longer in undeposited funds. If we double click on any of the deposits, we go back to a deposit type screen. So this deposit screen means that we're going to be taking money out of the checking account. And if we went through the normal process, the other side will be displayed here as undeposited funds, taking it out of that holding account. So we're going to close. Now note that this deposit screen can be used for other kind of deposits that don't go through that process. Just a deposit for a loan or something like that, we could enter into this screen as well. And that would mean that this account would be different, but that wouldn't be part of our cycle here. Our normal cycle would be from the customers. So I'm going to close this back out, and we'll close this back out. We'll go back to the home page in the open windows home page. So that's going to be our normal flow. So we can see that would be our normal flow if we bill the clients. Now, if we're in like a restaurant or something where we do the work at the same point in time, then we can in essence skip these two sections right here. We have a similar form as the invoice, but we're really just creating a sales receipt. So it's kind of like you could think of a check register. If we're at the store where we sell guitars, someone comes in and just buys a guitar and goes to the check register and pays us, then we have the same information we need for the invoice. However, we received the payment. We don't have to get the received payment. We're already here. And so we would just go to the sales receipt. And then we would enter similar data as we had for the invoice. I'm gonna go back one so we can see it. If we go back one, then we have similar information we had for the invoice. This is the invoice or the item that we sold. And we would have the same kind of transaction that would increase sales. This would increase sales, revenue, or income. This form would drive that increase. And the other side, instead of increasing accounts receivable, as was done with the invoice, would be increasing the undeposited funds, like cash, but it hasn't been deposited. So the first kind of two steps of the invoice and then receiving payments would be combined together, and we are now directly at undeposited funds. So, and the other side, if we sold inventory, then we have to deal with cost of goods sold, and inventory and sales tax here would be affected. This isn't inventory, actually this is rent. But all those items would be dealing with as well. We won't get into the inventory items. If it was a service company, then we would just be recording an increase in sales, and the other side would be undeposited funds. So let's take a look at an example of that. If we close this out again, and we go back to the balance sheet, the open windows, and we're going to go into the undeposited funds. So here's undeposited funds, double clicking it. and then looking for a sales receipt. Any of these sales receipts, then if it says sales receipt in the type, we can double click on that and we'll see a sales receipt. So the sales receipt's increasing undeposited funds. That's one side of the transaction. And you can see how going back and forth from the financials to whatever we input will really give us an idea of what the double entry accounting system is doing. So we're going to close this back out, close this back out. We're back on the balance sheet. The other side is going to be on the income statement, or profit and loss, as it's called in QuickBooks, profit and loss. And we're going to go into merchandise sales, double click on that item, and we'll see that these will be driven by invoices and sales receipts increasing the merchandise inventory revenue. That's what this is. Double clicking on that, there's a sales receipt. So I'm going to close this back out, close this back out. Those are the transactions that will happen there. Back to the home page. So if we're in a company that mainly makes the sale at the same point in time, we just go make the sale, and then we make the deposits as we would. So if we were in the store, we're just all we do is sell guitars in the store. We're just going to be creating sales receipts all day, selling the guitars and or our service, our guitar lessons, collecting money, giving the customer sales receipts. We can print these out, and then we'll go to the bank at the end of the day and record all the sales receipts that are currently in undeposited funds for us into the bank, transferring it from that undeposited funds into the bank. So those are the major two flows that we have. Now, this would be if we're dealing with credit cards. We could set up the credit card. These are going to be changes to statements that we could have, like invoices, and then we can look through the statements here using this statements item here. But this is the main flow chart we would have. Estimate, if it's applicable, invoice, billing the client, receive payment, we can imagine in the mail, then we go to the bank, or we just collect the payment at the same point in time we do the work, such as within a store, and then go to the bank at the end of the day. For more accounting information and accounting courses, visit our website at accountinginstruction.info.